to the Selections podcast. Today is Friday the 28th of October 2022. We're following up from a roundtable lunch that we had on Wednesday, where we had our guest today, Sam Lee from Capricorn Financial. Welcome, Sam.
Thank you, David.
And Sam is a UK mortgage broker based here in Singapore, and they also have offices in Hong Kong. Essentially, arranging mortgages for people in Singapore and Hong Kong buying property back in the UK. So we had a great lunch. Lots of questions came up, and I know those couldn't make it, and other people may be curious to know some of the answers, so that's why we're recording today. Sam, do you want to just give us a quick snippet of who Capricorn are, who you are, etc.?
Yeah, definitely. So Capricorn Financial, we are the largest independent mortgage brokerage in London. So we're headquartered in West London, in Hammersmith. We have around 60 advisors based there. And of course we have our overseas offices. I'm based in our Singapore office. I moved out here in 2019. And our Hong Kong office opened in 2020. So I've been at the company for 12 years now, and for a long part of that I've specialised in helping non-UK residents to get financing. So expats or foreigners buying in the UK or own property and they want to finance, then we're able to assist. We are a whole of market mortgage brokerage regulated by the FCA in the UK. So we have access to all the different lenders, all the banks, the building societies. We have offshore lenders. We also work with some of the Singaporean, Hong Kong, Malaysian banks. And our job is to find the best products for our client and to manage that whole mortgage application process for them. So that's a bit of an overview.
Excellent. And I know for a lot of people, buying property in the UK when sort of 7 or 8 hours, depending on the time of year, time difference, can be a really frustrating, challenging time. I was talking to a friend yesterday who's just completed on a property, and just dealing with the lawyers, solicitors, etc., and adding the mortgage broker on top can be really painful. So I think it's quite useful having a man on the ground, so to speak, or a business on the ground here.
Yeah.
So the idea being, I've got some questions noted down from our lunch, and we'll just sort of run through some of those sort of key areas really. Obviously, right now, as I said, it's October 2022. We're in a changing environment. Interest rates are rising for the first time in 15 years, really, post-financial crisis. And it's, I suppose, homeowners that are going to be starting to sort of pay the most attention to this. Looking at their existing mortgages, or indeed if they're due to be buying a house fairly soon or been thinking about it, there's going to be a lot of questions around interest rates. So give us a quick, an idea really of what are the current sort of variable tracker rates or fixed rate mortgages you're seeing, and how has that really changed? Because I think for the last sort of 10 years or so, non-residents have really been paying a premium over residents for mortgages in the UK, and has that changed as well or not?
They have, yeah. No, absolutely no problem. I mean, if we're just focusing on mortgages for non-UK residents, then for the large part of the last few years, I would be quoting clients around 3 to 4% on average, I would say.
Is it fixed?
Fixed or tracker rates, there wasn't a huge difference, to be honest, back then.
Right.
Nowadays, obviously, there's been a lot of change this year. Obviously, the Bank of England base rate has increased several times, and so banks have naturally had to increase their rates as well, because their cost of funding has gone up. There was even a point where some lenders withdrew their products altogether because there's a couple of things involved there. One, they couldn't handle the volume of applications they were getting, because people were wanting to quickly submit applications to fix their interest rates, because obviously they could see what was happening in the news. They might have been on variable rates themselves, so their rates were getting more expensive each month. So the banks were getting slammed with applications, and turnaround times really suffered. And of course, the second part of that is the costs of borrowing to the bank themselves have increased, and so their margins therefore have been impacted. So what we saw is some lenders withdrew products just so they could reorganise themselves and reprice. Since then, most lenders have come back into the market. Some still have been taking a bit of a back seat because of more uncertainty around, particularly in the UK, the economy. And what we're seeing in terms of interest rates right now, there's a greater availability of tracker rates. Tracker rates normally starting around 4% right now. That's including the spread. Fixed rates, there's not as many available. If you want a 5-year fixed rate, right now the lowest you could expect would be close to 5%, but some lenders are looking 6 or 7% instead.
Wow.
So it is quite expensive. But that's not unique to the overseas market, to expats, for example. It's also the case in the UK. I speak to my colleagues in our London office, and they're quoting their clients around the 5 or 6% mark as well. So that margin or premium has more or less disappeared, which is, I guess, kind of a silver lining.
Yeah.
But of course, rates are higher. A lot of banks, they brought out tracker rates with lower margins than they previously offered. And most tracker rates have no lock-in or exit penalties, so they're allowing clients to switch to fixed rates once they bring back fixed rates later on, or pay off their mortgages if they see fit.
Yeah. Mm-hmm. Okay, great. And so, it's one thing to ask you what are the interest rates now at the moment. Obviously, the one thing that often impacts an interest rate that a mortgage provider will offer is the loan-to-value ratio.
Sure.
So when talking about these rates, you're looking at maybe a sort of 75% loan to value. Is that typical? And how much cheaper can you get it if you've got a much lower loan to value?
It's a good question. So the maximum loan to value for a non-UK resident tends to be 75%. And typically you used to find that the rates would be a bit more expensive for 75%, and then at each 5% increment they would get a little bit cheaper. And then the sweet spot tended to be around 60%. Now what we're seeing is that there's less of a differential between the loan-to-value limits. I think when the rates were lower, then that was more prevalent, but right now we're seeing less difference at all, really. In fact, it can be more challenging to get up to the higher loan-to-value for buy-to-let mortgages. The reason for that is that lenders will have a rental income stress test, and to give you an example, they would want the rent to cover at least 125% of the monthly mortgage interest payments. So given that interest rates are rising and so the monthly payments are going up as well, it can be more challenging to meet those stress tests. So based on the same rent you were achieving last year, you wouldn't be able to get as high a loan. So that's why we're now seeing the maximum loans come in at around 65 or 70%. But I guess one good side of that is that rents also have gone up in the UK, seemingly. If we're speaking to some of the lettings agents we work with, they're talking about between 10 to 20% increases when they're doing the lettings renewals. So I suppose that is helping a little bit towards the rental stress test, but it's certainly a challenge to bear in mind.
Yeah, I suppose that depends on timings for people.
Yeah.
So if people are refinancing at the moment, and they're not passing that stress test, does that then inhibit them being able to refinance? They just have to stay with their current lender, maybe just take another rate from their current lender only?
That's right, exactly. So sometimes they're just unable to pass the stress tests elsewhere, but if you're refinancing with the same lender or doing a product transfer, as they're known as, then typically the lender wouldn't need to reassess your kind of personal finances or the rental income. So that's one way around it. There are also lenders that they're not just purely looking at the rental income, they're looking at your overall affordability. So they'll take into account your surplus income. So they have an approach called top slicing from your surplus income each month, and that can help to borrow still at the higher loan to value. So there are some solutions if it's not quite fitting with the stress tests, as long as you have strong finances, of course.
Yeah. There's tends to be sort of a growing trend at the moment, particularly I've noticed out in Singapore, amongst the Singaporean population as well as with expats that are packaging their property into a corporate structure. How does that impact the financing solutions that are available?
It's a good question, and definitely we've seen this trend as well, because there can be some tax savings for certain individuals by having it under a limited company. And we have seen some more lenders open up their doors to limited company applications than there were previously, because not all lenders will lend if you're buying through a company structure. For some, it needs to be in your individual name. So the number of lenders that are lending to companies has certainly increased over the years, but by buying through a company structure, of course, you're not going to have access to all the lenders, so you might be restricting yourself slightly, and because of that reason, it can sometimes be more expensive, but you'd hope that the tax savings would offset that.
Very good. And we talk about sort of variable tracker rates and fixed rates and 2, 5 year, etc. What's the, someone was panicking that they thought, interest rates are going to keep going up for a long, long period of time. Mm-hmm. What's the longest that someone could fix a mortgage for typically?
Typically 5 years.
Yeah.
We have seen some lenders in the past offer 10-year fixed rates, but they haven't been all too popular. People are concerned that they're therefore locked in for 10 years with quite onerous exit penalties.
Yeah.
So, of course, you don't know what's going to happen within 10 years. I mean, look what's happened over the last, 2-3 years. It's been quite unpredictable. So people don't want to lock in for quite that period of time. But with 5-year fixed rates, there's plenty available, and I think it's a good kind of medium-term product to look for.
Yeah, completely. And historically, have you found that most clients prefer? What does the majority of people do? Do they take a variable, a 2-year fixed, a 5-year fixed? What's your most popular?
I would say in recent years, more people have been going for 5-year fixed rates because rates have been so low, so they've been able to secure their rate for longer. Whereas previously, I guess there was more tracker rates that my clients were taking. Another thing around 5-year fixed rates is it links back to what I mentioned earlier about the rental stress tests. So some lenders will have a different stress test for a 5-year fixed rate than they would do for a floating rate. Yeah. And it's normally more lenient for a 5-year fixed rate. So that's one of the main reasons people have been going for those longer term products. It gives the banks more reassurance that obviously payments will remain the same, and so it helps with the stress testing, of course.
Yeah.
Whereas in the past, we did see a lot more tracker rates. But then my clients that took out tracker rates within the past few years have been knocking on my door this year saying, Sam, our rates are going up. What can we do? Can we lock in the rate now? Of course we can, but it's more expensive than it would have been if they'd locked in a year or so ago.
Yes, completely. And can you still these days as a non-resident buying a buy-to-let property in the UK get an interest-only mortgage?
Absolutely, yeah. If it's a buy-to-let property, then almost all UK lenders would provide an interest-only mortgage. But there's more offering interest-only than there are offering repayment.
Oh, wow.
Yeah, I mean, most would offer both, but there are 2 or 3 lenders who do prefer it to be on an interest-only basis alone. So that's certainly not a problem, but what you tend to find is that particularly the Singaporean and Malaysian banks, they don't actually offer interest-only facilities at all, even if it's a buy-to-let mortgage. So if you're borrowing from the local Singaporean banks, then you would struggle to get an interest-only loan. And if you're buying a property for your own personal stay, then that's different, because then it becomes a regulated mortgage and there's more criteria around taking an interest-only loan, because the bank needs to be sure that there is a suitable repayment vehicle in place to pay off the loan by the end of the term, which could be savings, could be pension, could be background properties that you plan to sell. So there's a few different factors, but for buy-to-let, certainly interest-only is very much available and tends to be the preferred choice for most investors.
Yeah, I can see the appeal, particularly as a non-resident. But with that, if you have an interest-only mortgage, what sort of allowance do the banks have for you to overpay? If you wanted to bring the balance down, or
sure.
I think one thing that came up at lunch was also the reintroduction of offset mortgages.
Mm-hmm. Yeah, absolutely. So in terms of overpayment allowance, then most banks would have a built-in allowance of 10% each year. So that's 10% of the outstanding mortgage balance that you can overpay by on top of your monthly payments each year without incurring a penalty. With some banks, it could be up to 20%. And if you're taking a floating rate which has no exit penalties at all, then normally you can pay up as much as you wish. There are some fixed rate products that don't have the allowance to make overpayments, so be mindful of that. but the majority would have that built in. And as you said, we have seen offset mortgages rear their head again with a couple of different lenders. Now that interest rates are rising, then they are certainly looking a bit more attractive than they once were. If your rate was only 1 or 2%, then having money in an offset account isn't really going to save you too much. But when rates are 5 or 6%, then suddenly it's quite appealing. Yeah. So I wouldn't be surprised if we see more banks starting to offer offset products as well.
Yeah, me too. And how, obviously we're in quite a rapidly changing environment with interest rates at the moment, with the Bank of England meeting every month and potentially increasing interest rates every month, and not just small increments either. So how fast moving is the product offering from the lenders at the moment? Are they pulling rates right, left, and centre, and taking a while to issue new products, or how nimble are they being?
Yeah, I mean, certainly this year I've seen rates pulled and changed more than the last probably 7 or 8 years. And so the banks are relatively nimble. I think for a while there were certain margins built in already based on forecasts, so it's not always a snapshot. As soon as the base rate goes up, fixed rates increase in line with that. But when they go up by 1% in a month's time, then of course the banks have reacted, and that's what has resulted in lenders kind of temporarily withdrawing, waiting till things settle down, and then coming out with repriced products. Of course, if you're on a track or a floating rate, then that is instantaneous. Your rate is going to go up in line with any base rate changes, or depending on the index that you're against. And for that reason, that's why some lenders have completely removed fixed rates, and what they've just left is the tracker rates, because having to keep repricing every month has just been chaotic for them, and I guess they haven't really had the systems and processes in place to allow them to be that nimble.
Yeah, for a tracker, they just keep their margin. They just go, sure.
Yeah, it's more straightforward.
I mean, how's the view from the lender's standpoint of London versus tier 2 cities, etc., or even any other locations around the UK?
If it's a UK lender, then they tend not to mind. We can get lending anywhere, certainly in England, Wales. Scotland can be a little bit more of a challenge with certain lenders. Northern Ireland, the question came up on our lunch, it is very tricky for some reason. But in England and Wales, no issue. Of course, a lot of it also comes down to the value of the property and the quality of the asset. Certain lenders in the international space will have minimum loan amounts, and they tend to start around £100,000. So if you're buying a property up north, it's less than £100,000, and that can be very tricky to finance.
Yeah.
There are lenders that have slightly higher minimum thresholds. There are a couple of lenders with 250 grand and 500 grand minimum loan amounts. Of course, that's going to come into play. And there are some lenders that would only lend in London or the home counties. But those bigger lenders, your kind of HSBCs, NatWest, Barclays, they'll lend nationwide. And of course, it's always going to be subject to survey. And so they'll want to send around an independent surveyor to value the property and to make sure it's a suitable security for their loan.
Yeah. And so that sort of prompts another question from me, really. If you are getting a more significant mortgage, so a higher value property, is it easier or is it harder to get a better rate or lending?
I would say typically it would be slightly easier. Obviously, depending on your personal finances, as long as it's justifiable and it's affordable, but assuming all the boxes are ticked, then some lenders have different tierings on their products based on the loan amount.
Yeah.
And typically, the bigger the loan amount, the better the interest rate would be, or certainly the more bargaining power you would have with that lender. So we do tend to find that yes, you can typically get a better rate the higher the loan amount, probably more lenders you can access, better products, but then more expensive properties, particularly in London, tend to come with lower rental yields. So again, that comes back to the rental stress tests, and you probably struggle to borrow, say 70 or 75% to buy a property worth £2 or £3 million in central London, because it won't satisfy the rental stress test. And for that fact as well, some lenders, if you are borrowing, let's say above £1 million, then they would tend to cap the loan to value at a slightly lower level.
Yeah.
But as long as you have the deposit, then you typically would expect better rates for a higher loan. And once you get above, let's say, £2 or £3 million, then there's a whole different range of lenders you can access, which are the private banks, and with them, it's you can get some more favourable products.
Yeah.
Absolutely. Yeah.
I suppose they have to do less work for reward of
Yeah,
interest in that.
of course, and they're looking for the wider relationships as well. In some
That's
instances.
especially with the private banks.
Mhm.
Is there any current fear from the banks and the lenders? Have they? You talked about rental stress tests. We know income, etc. Sort of proof of net worth. Have they amended any of that criteria recently, or is it largely still all the same?
Largely, lending policy is unchanged. And from speaking to lenders on a daily basis, they are quite keen to let us know that their appetite is still there, targets are still in place, so they still do plan to lend their money. I guess one thing that has heated up a little bit this year is on the kind of source of funds, the AML, anti-money laundering side of things. Perhaps that's something to do with the war in Ukraine and so-called dirty money turning up in London. So there's been a greater spotlight on that, and certainly more pressure on the lenders and on solicitors to make sure they understand exactly where the funds have come from and being able to provide audit trails to evidence that. And that pressure, of course, has trickled down to us as mortgage brokers as well.
Yeah, pass on the responsibility.
Yeah.
So typically when buying a property or trying to effect or arrange a mortgage, you need an agreement in principle from the lender first.
Yeah.
To be able to know that you're going to then go, right, I can go and make the offer on this
Sure.
property with certainty of getting the lending. What's the current sort of turnaround time for that? Has that changed? Is it?
Hasn't changed. No, I mean with some lenders it can be done very quickly. They have sort of online systems, and we can turn it around within an hour or two. With other lenders, then they tend to ask more questions, and it needs to go to an underwriter. So some have different processes. It can take anywhere from an hour to a week or so. But of course, it's one thing to note is that some approvals in principles may be more robust than others. If you are able to obtain it in just an hour, then clearly it hasn't gone in front of an underwriter, it hasn't been properly assessed. Whereas if it's taking a week, then it's probably more of a thought through process and
it's more certain for you.
Yeah. So if we're going to get you approved in principle with a lender that we know it can be turned around very quickly, I would still tend to ask for more items than the lender would actually need initially, just to verify that what the information we're providing is correct. So we would want to see proof of income. Some instances we want to see local credit reports, so that we know that if we've got that approved in principle back, then there's a very high chance of that being able to convert to a full mortgage approval once it comes down to submitting the application.
Yeah. And I assume it's slightly different between a UK and domestic lender, or domestic being in Singapore or Hong Kong. Would the UK lender want to also see a Singapore credit score, and vice versa, really, with the Singapore lender also want a UK credit score?
Yeah, so it is different if you're applying in the UK versus abroad. I mean, if you're a UK resident applying with a UK bank, then normally they would do a credit check on you, and that allows them to do approval in principles pretty quickly. But of course, a UK lender can't do a credit check on a Singaporean resident. So some, as you rightly say, do request credit reports, typically not at the approval in principle stage, but certainly for the full mortgage application. If not, then they'll certainly want to see kind of all bank statements for a 3 to 6 month period. And if there's anything showing on that bank statement, like credit card payments, loan payments, mortgages, that have not been disclosed, then of course the bank's going to query that, and they're going to want all the full information and supporting documents around that. For a Singaporean lender, again, they wouldn't do a UK credit report, but they would expect you to disclose all of your assets worldwide, and they typically would get a local Singaporean credit report.
Interesting. Yeah. And do you typically, there may or may not be an answer to this, do you have a go-to one or two lenders? I mean, do you tend to do more lending through UK lenders or more through the local banks here?
Yeah, I wouldn't say we necessarily have a go-to lender. Obviously, we wouldn't be doing our job correctly if we're just pushing somebody to
There are
one
periods
particular
of
bank.
time where they have the best rates and the
Correct.
best service, and
Yeah, I mean there was
someone wants market share.
absolutely. There was a long period of time I remember where we were doing an awful lot of applications to Bank of China because their rates were just market leading.
Yeah.
But they only offered tracker rates, or at least the tracker rates were so much better. But as soon as the base rate goes up, it was less appealing. And so, there's a greater spread of lenders that we're using these days. It really comes down to individual criteria and situations. Okay, a UK expat would have different options than a non-UK citizen.
Yeah.
And if you have an existing property in the UK, again, you have more different options because some lenders have that as a prerequisite. You need to have at least one UK property. So I guess, the core lenders that we've been working with would be Bank of China, as I mentioned, but also the likes of Skipton International, who are a favoured lender, I would say, because of their speed and turnaround times, and they've had some pretty good products. We've got like a Gatehouse Bank, who are Sharia compliant, but they can lend to residents of people in, I guess, higher risk jurisdictions.
Right.
That was quite useful, and they, at one point, they could lend up to 80% loan to value. They could lend to limited companies. We were doing a lot of applications for people in mainland China with Gatehouse Bank. And then we've got the more well-known lenders like HSBC and NatWest International, Barclays Wealth, Standard Chartered. These are all lenders that we would use fairly frequently. And there's a few like smaller building societies or smaller lenders that you wouldn't necessarily have heard of, but we do use them on a frequent basis, particularly for expats, like a Keystone or Hampshire Trust Bank, Lendco, and so on. So there's quite a wide spread of lenders, certainly more now for non-UK residents than they were when I started this job.
Yeah.
Yeah.
Good. Well, there was certainly a period of time I know from being out here for quite a long time already, where it used to be, I suppose, almost any normal UK lender that people were used to would lend to a non-resident, and then post sort of a few years after the financial crisis, when they were de-risked, it became very difficult, and I'd get bugged with that question all the time, going, where can I get a UK mortgage? And Capricorn weren't out here at the time, and it was a case of, well, try your bank, international, like NatWest International, or there really weren't many. And then the local lenders, I think, only really lent inside central London, not even necessarily inside the M25. It was very few areas. But no, it's good that people have more options available to them, and typically ones they can't necessarily go directly to themselves anyway, right? These lenders only really want to deal with an intermediary like that can do it for them.
Exactly. We've certainly, since being out here, the introducers, the agents, developers that we're working with certainly value us being here on the ground, being able to speak to clients, attend property events, and help provide their buyers with certain guidance.
Yeah. Good. Just seeing if we've got any other questions that I haven't. Oh, here's one question. So obviously one of the main customer bases you have here, very popular in Singapore, buying properties in the UK off plan.
Yeah.
There's quite a few agents out here and even developers out here.
Yeah.
Now, a lot of those properties that were being bought in the last few years might only just been completed, and you'll be doing the mortgages for them now, I suppose.
Yeah, very true.
Have you seen any change in the valuations that the mortgage companies are applying to those properties? Are people being able to have the loan to value at the value in which they agreed to buy that property?
Yeah, I'd say it does present some challenges. Definitely, certain lenders actually apply what they know as a new build premium.
Right.
So they would actually instruct the surveyors to take into account the fact that it's new build and make normally about a 5% deduction on what they think the market value is.
Yeah.
So that can create some issues in terms of getting the loan to value the clients need. Plus, some surveyors, they in order to provide a valuation, they need to provide at least 3 what they call comparables. So they look at properties which have sold or rented in the local area recently that are of a similar calibre, same kind of square footage within normally a quarter of a mile, and they see how those prices stack up with the purchase price, and they've got to base their valuation on that. So the issue you have there is where it's a new build property in a regeneration area. For example, there's a development I've been dealing with in Wembley where there's not too much in the local area of a similar calibre to match it up with, and sometimes the lenders insist on surveyors using second-hand comparables, so they can't use evaluation from a property in the same building or a neighbouring new build building. It has to be something second-hand that's sold recently. But of course, these new buildings, they've got their 24-hour concierge, you've got fully equipped gyms and pools and stuff, and the neighbouring property will be nowhere near as nice as that.
Yeah.
So it can be hard to kind of justify the valuations.
Yeah.
And so in those regeneration areas, that's where we tend to struggle the most in terms of getting the valuations to stack up.
Yeah.
So that it certainly has been a challenge that we've been dealing with. And really the best advice to give to the client is to be prepared to put down a slightly higher deposit. Don't put all your chips on borrowing 75%.
Yeah, leave yourself some room for it to be 70 or 65%.
Exactly, yeah.
And is that similar also, like in Liverpool and Birmingham? I see Manchester, Birmingham, and Liverpool advertise quite a lot.
Exactly the same. Yeah,
planned property.
You do get that similar challenge because
a lot
in
of
those areas
are regeneration zones as well, right?
Precisely that. And another thing you find is that in, let's take Manchester for example, a lot of the new build developments are sold predominantly to investors and more often than not overseas investors.
Yeah.
And some lenders don't like that. In fact, they want, let's say, at least 50% of a development to be owner occupied.
Yeah.
Because their fear is that it will impact resale value of the property. If the only people living in the building are tenants, then it's not going to be as attractive for somebody buying it for their personal use.
Yeah.
So we've had some developments be declined on that basis where it's been sold predominantly overseas. So surveyors, they're looking at the marketing material, they're seeing whether or not it's available on the Help to Buy scheme, they're asking a lot of questions about the owner-occupier ratio, and they're basing their decision on that.
Interesting.
Yeah.
Another thing that comes up now and again, and it came up at our lunch as well, is some people will be buying a property back in the UK to rent out, but potentially rent out through like an Airbnb, short stay sort of agreements. Is that something that lenders take interest in, as in don't take too kindly to?
Well, pretty much. There's normally a policy in place that says that the property would need to be let on an AST, an assured short hold tenancy agreement, and normally it needs to be a 1 or 2 year agreement. So, of course, if you're letting it out on Airbnb, then you're going to fall foul of that policy.
Right.
So, if you're going to go down that route, then there are specific holiday let mortgages that you can take out with certain lenders. Not all lenders offer this, of course. You do tend to find that there'll be a slight premium on the interest rate for this.
Yeah.
To account for that, it's considered a higher risk for the lender, of course. They much prefer just a long-standing tenant in place.
Yeah.
So that needs to be factored in as well. And if it's your first property in the UK and you're looking to set it up on an Airbnb basis, then you're going to struggle really because there wouldn't be too many lenders available.
Yeah.
But there may be some options, and we can help explore that.
Do you have any difficulty on that sort of basis? We go back to the credit rating, etc. There's always a lot of hearsay in amongst people, expats or non-residents, about worried about when they repatriate in the future. Do I need to have had a mortgage or even just a credit card or something in the UK to even develop a credit rating, a credit score in the UK? Do you have people that are almost sort of disappeared off the radar of the UK credit ratings and then have a real difficulty, or is that not actually a big problem?
It can be a problem. If you were to move back to the UK, then some lenders, for example, they would require you to have a 2 or 3 year UK address history as like a qualifying criteria, so it would struggle. But there are some lenders that are more flexible in that regard. Some don't have that minimum residency at all, but they would generally want to pick up some kind of credit score for you. So if you are looking to move back day one, having been off the grid for 15, 20 years, then I guess what you probably want to do is get yourself a credit card, make sure you've got a permanent address registered. I guess you could do some of this before you move back, for example, your parents' place. Other things can improve your credit score, such as getting registered on the electoral roll and on utility bills and so on. So certainly there's things you should look to do to improve your credit score. But it also comes down to your level of deposit, because typically you find the credit score requirements are more stringent the higher the loan to value. So if you had a 50% deposit, then it wouldn't be so much of an issue. If you want to borrow,
a bit more relaxed about it.
Borrow 90%, then it could be a challenge.
It's all on their risk.
Exactly.
Yeah, I suppose makes sense.
Yeah.
And I think, unless I'm missing any other questions that came up. Yeah, actually on that point, there's two sides to this, I suppose. You mentioned one just now, if you're moving home, but already acquire a property. But also I suppose what happens a lot for people is that they get expatriated to Singapore, moved out here with their company, etc.
Yeah.
But they've just, they've got a home in the UK that they were living in, that then they move out of and decide to rent out. So they become an accidental landlord in that regard.
Yeah.
They're most likely on a residential mortgage at that point. What do they need to do? Do they wait till the end of their period, and then when it comes to refinancing, tell the bank that they're now, it's actually now a rental property, or should they actually tell the bank straight away and be adjusted? But what do the bank, and how does the lender tend to deal with that?
Yeah, I mean, well, as a mortgage professional, I would say that if you were to move abroad and let out your property, you would need to inform the lender. You would need to get what they call consent to let.
Right.
So it's quite simple. You call up the lender, let them know the situation, and there's rarely an instance where they wouldn't provide that consent to let. Some lenders would put a slight premium on the interest rate. It could go up by 100 bips. But for some, they'll just let you ride out your fixed rate. But at the end of that fixed rate period, you wouldn't be able to switch products, not on a residential basis. You would need to remortgage to a buy-to-let.
Does that involve doing that whole process with rental, proof of rental and stress testing and things like that, rather than just rolling into a buy-to-let premium?
Correct. Yeah, you would need to go through a full mortgage application process and have the property valued, get solicitors involved, and so on and so forth. So it's something that does come up quite frequently, because many people, as I'm sure you've experienced, do find themselves in that position. But there are still plenty of mortgage options for people in that scenario, so we can help guide them through that process.
And on the flip side, some people can't start looking for a property to move back to, and sometimes they find that property immediately and they're not actually moving back for another 18 months, 2 years, etc. And they might decide, okay, I'm going to buy this family home, but I'm going to rent it out for the period of time until I go back there.
Yeah.
So they need to do a buy-to-let mortgage. And then when they're about to move back into it, can they really benefit by moving, or letting the bank know, or
yes,
are the banks willing to? Yeah.
That's the difficult thing. So
to be kind and friendly and go and have a cheaper mortgage. Now you're living in it.
No, so it's easier to go from residential to buy-to-let than it is from buy-to-let to residential, because of the way that the different types of mortgages are regulated. Because as I mentioned, buy-to-let mortgages are non-regulated. So if you were to move into that property, then effectively the only option is to remortgage onto a residential instead. You couldn't get consent to live there.
Right.
Sadly. So in that instance, if someone was planning to return into that property in the foreseeable future, then we would look to put in on a product which has a lock-in period matching with their desired timeline, or something with no lock-in period at all, which, as mentioned, a lot of the tracker rates right now have. Because they will want to remortgage as soon as they're planning to move back. I mean, they could apply for the remortgage before they return back and have that all approved, and then the day they're looking to move in, then they can action that remortgage. So
Yeah.
it can all be done from the Singapore. But of course, as a UK resident, there are going to be more residential mortgage options available for you.
Yes, true. Let's that leads me on to sort of final question, really.
Yeah.
If someone has a UK property already on a current, let's say, fixed deal, or their current rate is coming to an end at some point,
Yeah.
or they're in the process of looking for property, at what point before the rate changes, how far in advance should they really be getting in touch with you to look at that? I mean, how?
Yeah. So mortgage approvals are normally valid for 6 months.
Okay.
So that would be the best time to start looking
Does that keep that rate for you as well?
Yeah, so typically when you submit a mortgage application, that will lock in the interest rate. Although we have found over the last few months that some lenders have kind of pulled applications mid-process. It's quite rare for that to happen, but it does unfortunately happen where you're having these sort of turbulent periods. But in normal times, you can secure an interest rate up to 6 months ahead of time. And bear in mind also that it can take 6 to 8 weeks to actually have the loan approved.
Yeah.
So let's say if you had a property that's completing in 7 or 8 months' time, we could start the process now. It would take a couple of months for it to be approved, and then from that point, normally you'll have 6 months to be able to draw down that loan. So it would be a good idea in the current climate to get something submitted so you can secure an interest rate to prevent you taking a higher interest rate later on.
Yeah.
But there's normally nothing there for tying you into that product until you actually draw down the loan. So if rates do miraculously reduce at the start of next year, you could then reapply for that cheaper rate, assuming you still have time.
Yeah, so it's the bank's obligation essentially to lend it to you at that rate. It's not your obligation to actually draw down on that mortgage.
Yeah, exactly. Yeah.
Okay, very good. And if people listening would like to get in touch with you, they can obviously find Capricorn Financial on the internet and find you there.
Yeah.
But also you can I'll happily pass on your details to anyone that asks for it.
Yeah.
Have you got any other sort of pearls of wisdom or anything you'd like to add in before we?
Everyone's situation is unique.
Yeah.
So it's really hard to give kind of a blanket one-size-fits-all piece of advice. So really, the best thing is to obviously reach out to yourself, and you can make introductions to me. I can then have a sit down with somebody and fully understand their situation, and then make some suitable recommendations based on what their requirements are and their specific scenario.
Very good. Well, all that leaves me to do then is thank you for your time.
Pleasure.
Thank you to those of you listening. And please get in touch if you'd like to speak with Sam.